Hi everybody, Thomas Moore here. Have you ever felt like investing in the stock market wasn't just confusing? It was like pulling the handle on a slot machine. You're not alone. Despite years of training and experience in the brokerage and mutual fund industry, I struggled to make money on a consistent basis in my own investments. After years of study, experimentation, and discussion with other investors, I finally hit on the basic principles that have not only defined my success since, but have also become the foundation of the Rebel Income investing system I use in my own investments and also make available to my clients. Before I tell you about these critical principles, I want to take just a minute to invite you to check out my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis in search for the trades I publish for my trade alerts, to lists of underpriced, dividend-paying stocks, and even weekly recordings discussing current open positions and current market conditions. You'll find the link in the description area for this video. Take a look. I know you'll find something that you'll be able to use in your own trades. Mutual funds, financial planners, and investment advisors, in my opinion, are all guilty of preaching the same tired and ultimately incorrect line about how to make the market work for you. Keep a long-term perspective in mind, be patient, and let the market ride through its ups and downs. That advice sounds good on its face, but for most investors it falls flat when the economy and the market enter extended downward periods, like a recession. Why is that? Because it's next to impossible to watch your hard-earned and carefully saved investment dollars simply waste away during a bear market. As a younger investor, I learned this lesson the hard way. After carefully building up my retirement savings through 401k and IRA investments throughout the 1990s, I watched the dot-com boom go bust in 2000. My prior experience in the brokerage and mutual fund industry had me parroting most of the same "it's a long-term investment, be patient" kind of nonsense to myself as well as to my friends in those early stages. But after watching those retirement accounts dwindle to less than half of their value by the end of 2002, I decided it was time to stop trusting people who clearly didn't care as much about my money as I did, and to take matters into my own hands. I started studying about the different kinds of investment vehicles that were available in the financial markets, including stocks, options, commodities, currencies, and so on. I read books and talked to other investors about strategies like swing and momentum trading, option spreads, and a lot more. I learned how to read charts, identify trends, and analyze price action down to the minute. I experimented with just about every method I could find to try to duplicate the success I read about that some of the smartest investors in the history of the market had achieved. I really liked a lot of those strategies. They were kind of fun. And I even found some success buying call and put options depending on the type of trend I expected a stock to form based on current price momentum and market sentiment. Inevitably, however, I found my efforts frustrated by the simple reality that I was placing more losing trades than winning ones. The really frustrating thing was that just about every book I read about the strategies I was using made it clear that my experience wasn't unique. In fact, even the best professional traders learned to accept the reality that they would be wrong far more often than they could ever expect to be right. I consistently found that these expert traders were working with the tacit knowledge that they would be wrong as much as 75% of the time. Think about that for a minute. Even the best technicians and traders in the market knew they would lose money on 75 out of every 100 trades. Now, it is true that you can make money even with these low chances of success, what I call success rates. The catch is that you have to perfect the ability to maximize gains on those few winning trades, as well as the discipline to limit your loss on that overwhelming majority of losing trades. It's something that's very difficult to do. Have you ever tried to play the tables or the slot machines in a casino? You know going in that the house has stacked the deck against you. So maybe you just do it as a fun way to while away a few hours with money that you already knew you weren't going to go home with. It's one thing to gamble in Vegas or Atlantic City for a little bit of fun, But if you want to be a successful investor, you should never treat your investments as a game that you get to play with money that doesn't matter. The real problem I found with every single strategy that I was working with until a little over a decade ago was that the low probability of success in every single one of those trading methods makes it prohibitively difficult for an average guy like me to develop that skill and discipline to maximize my profits and minimize my losses successfully over the long term. I realized that few average investors have the time, patience, or financial resources to stay in the market long enough to really perfect those methods the way that they need. Let me draw another analogy that I think might help put this in perspective. As a kid, I loved to watch baseball. It was a lot of fun watching heavy hitters like Reggie Jackson, Dale Murphy, Mike Schmidt take big swings for the fences, and it was super exciting when they hit a home run. The more I learned about the game, though, the more I started to admire the methodical, high probability approach of guys like Rod Carew and Pete Rose. They wanted to get on base more than they wanted to hit a home run, so when they hit the ball, they were expert at hitting to open spots on the field. They also didn't mind being walked, so they never chased a pitch they didn't like. They knew they would do more to help their team win by getting on base and then getting around the bases than they would by swinging for the fences. I began to realize that if I wanted to be successful, I needed to find a way to stop swinging for the fences, hoping for a big gain on my winning trades. I started looking for a way to hit singles so I could get on base and work my way around little by little. In short, I started looking for a way to shift market probability in my favor. After more study and experimentation, I found the secret about 13 years ago in one of the annual reports that Warren Buffett is famous for writing for his company, Berkshire Hathaway. If you've got the time, his reports are really fascinating reading. In this case, Mr. Buffett wrote about a new position he had started accumulating in General Electric. He wrote about being able to secure warrants, which are an institutional equivalent of an option contract, on GE stock that would enable him to buy shares in GE at a deeply discounted rate at some point in the future. At the same time, GE was going to pay him a tidy sum in the form of dividends for as long as he held the warrants. Now, average investors like you and me obviously don't have the resources or the pull to make the kind of deals that Warren Buffett and other institutional investors can make. His story, however, made me start thinking of what resources are available that might allow me to mimic his approach on a smaller but practical scale. My thoughts went back to the low probabilities of success that I had been struggling with. In every case, I was acting as the buyer in the transaction, either with the stock itself or with stock options. Well, if being the buyer meant that I was going to lose 75% of the time or more, didn't it stand to reason that the seller on the other side of my transaction was winning more often than they were losing? I started experimenting with this theory and quickly realized that I had discovered an advantage that most traders simply ignore. I kept experimenting and refining my system, including the process that I follow to select the stocks I wanted to use in the trades that I make. Eventually, I had a system that I was ready to start teaching to clients. That's how Rebel Income started, and after a decade of ongoing refinement, it relies on just a few core principles. First, I use cash-secured put sales to generate conservative monthly income on stocks I'm willing to own. The income from these put sales has averaged about 2.3% per trade on the capital committed in each case. These are the singles that I can hit over and over again. Second, I rely on strict fundamental and value analysis to identify good companies trading at discount prices. I use reliable, time-proven metrics like free cash flow, net income, and a hard look at a company's balance sheet to help me screen through the thousands of stocks in the market for the very few that I'm willing to work with in my income trades. Third, I leverage the time decay of stock options by selling very short periods of time. Time decay means that every option contract has a specific, finite life, and it's the number one reason that option buyers lose money so much more often than they make it. For option sellers, time decay is an all-important ally that puts me on the right side of the market more often than not. Fourth, I accept stock assignments from put sales when the stock closes below my put sale strike price at expiration so that I can add stocks to my income generating portfolio. Assignments happen about 30% of the time in my experience. Holding those stocks, sometimes for months or even years at a time, provides passive income in the form of dividends that I wouldn't see otherwise. Fifth, I use covered calls on my stock positions to generate additional income and set up possible profitable selling prices. Selling a call option means that the buyer can force me to sell my shares to them if the stock rises above the contract price that I sold. If that contract price is higher than my original purchase price, liquidating my shares means I get the money I used to buy the shares back, plus some extra profit on top of any income I brought in from the put sale, from covered calls, or from dividends. Finally, I lather, rinse, and repeat. That means I apply this method again and again from one month to the next. That means that I can see a conservative but sustainable growth a little bit at a time, working my way around the bases a little bit at a time. My average gain on my Rebel Income trades is 2.38% for a 19-day average period of time. Repeating that process over the course of a year means placing 19 trades with the same amount of money. That means that my reasonable return expectation is 45% per year on the money that I commit to my trades. When you think about the fact that the S&P 500 index, which is the barometer for a lot of the very popular index-based mutual funds today, has averaged about 11% per year return for the past 50 years, I think the case for going after small, simple trades with few weeks at a time with a simple 1.5% to 2% return per trade target makes too much sense to ignore. I said earlier that one of the driving forces that led to building my trading system the way I have was the desire to shift probability in my favor. My initial expectation was that since as a buyer I was wrong 75% of the time, as the seller I should be right 75% of the time. I'm happy to say that I was wrong. In the 10 years since I started tracking my Rebel Income trades, I've closed 842 positions. A closed position covers the initial put sale to its expiration if I'm not assigned. If I am assigned, it covers the put sale as well as the entire time I hold the stock until I eventually sell my shares back to the market by being called out of a covered call trade. Now, out of those 842 closed positions, I've had 830 winning trades against just 12 losers, which means that my actual probability of success is more than 98.5%. You can see my results for yourself on my Rebel Income track record. I've put the link to my track record in the description area for this video. Thanks for your time, everybody. I appreciate it. If you found this video helpful, please go ahead and click here to subscribe to my channel so you can get notifications each time I publish a new video. You can also click here to see another good example of the kind of content I make available on this channel. I'm Thomas. Talk to you again soon.